Thank you, Ted, for your most kind words of introduction. And what I intend to do is to make a short introduction, as short as I possibly can. I will certainly be shorter than 30 minutes so that we have ample time to interact. In my experience, it is the interactive part of a session like this that is most illuminating, so I ask you to participate as openly as you're willing to do. So my topic today, as Ted already has already announced, is Portugal, and I'm going to be focusing on a major aspect of the adjustment program that my country is going through, which is the aspect of restoring credibility and confidence. I mentioned that at the beginning, and then I will spend some time at the end going through how exactly one can expect credibility and confidence to accumulate during the course of the program. The outline of my presentation today is very simple. First of all, I will make some remarks about what forces, what drivers determined the situation that Portugal found itself in just before the summer of last year. And this reference to the difficult Portuguese case is an acknowledgement of a paper that Olivier Blanchard, now chief economist at the International Monetary Fund, published on Portugal, if I'm not mistaken, in 2007. Then I will give you a characterization of the economic adjustment program of Portugal, and follow immediately through the three pillars of the program: fiscal consolidation, deleveraging and financial stability, and structural transformation. And then I will conclude by examining with you how the adjustment program will work. How will it deliver the results we're aiming at? So the first part of the presentation has to do with the diagnosis. How did Portugal find itself in a difficult position? Now, to be very simple, the participation in the euro area for a country like Portugal meant that the country was able to access financing at much better terms than it could previously. In that context, Portuguese households, Portuguese non-financial corporations found that they could get access to credit at much better terms, and that led to a quite substantial increase in expenditure. Interestingly enough, most of this added expenditure was not directed towards investment. It was basically current expenditure, and in terms of composition of investment, it was mainly concentrated in non-tradables and services. So it did seem like the expansion of the opportunity set, which was created by the euro area, led to a situation where the degree of openness in the country was actually reduced, in which trade unions, employers, and the government were able to explore rents in sheltered sectors, and that led to a political economic equilibrium, which was certainly stable for a while, but it was not conducive to innovation. It was not conducive to productivity growth. It was not conducive to sustainable employment creation. So the situation during the more than 10 years that were dominated by the dynamics of adjustment to the participation in the euro area were characterized by strong macroeconomic imbalances, unsustainable public finances, and excessive debt on the part of Portuguese households and non-financial corporations. At the same time, the economy was characterized by very low growth. As a matter of fact, during the years of the euro area, the only member state of the euro area that grew less than Portugal was, on average, was Italy. So the situation was clearly not bright when the global crisis started in 2007, but as it turned out, the trigger for the crisis in Portugal was the decision by the Portuguese government in 2008 to expand the budget quite aggressively in response to the global crisis. That attempt at expansion did deliver positive results in the short run in terms of economic activity, but obviously led to unsustainable levels of deficit and debt, and eventually to a completely unsustainable position in bond markets that made a request of international assistance unavoidable. So this is the story that led to the need for an adjustment program, and I will move to the second part of the presentation. I told you all of this, so don't worry. Now, what does the adjustment program do? The adjustment program does address the main problems and imbalances that I've just told you about. The adjustment program covers the period from 2011 to mid-2014. It foresees a financial package of 78 billion euros, of which 12 billions are earmarked for banking sector recapitalization. Very importantly, to my mind, and it will play a role in the argument that I'm going to present to you, each disbursement depends on the outcome from regular quarterly missions that look into the progress made on the implementation of the adjustment program. Those regular quarterly assessments cover fulfillment of the quantitative limits of the program, the structural benchmarks of the program, and even a thorough examination of the measures foreseen by the Memorandum of Understanding. The regular character of these examinations means that the program itself has a regular procedure allowing the country to put progress on record in a well-documented and transparent way. The relevant material is available from the website of the European Commission or from the website of the IMF, and those websites are updated regularly. The economic adjustment program protects the financing of general government in Portugal from the vagaries of financial markets, and that allows time to proceed with an orderly adjustment of the macroeconomic imbalances, while at the same time it affords us time to build confidence and credibility. So that is how it is supposed to work. Something that I believe is worth doing for an audience such as this one is to look back at the situation in my country in May 2011, and to see what progress has been made during this period. In the left-hand side column under main risks, you have 5 risks which were listed. I believe 5 main risks that were listed in a document by Standard & Poor, published, I believe, on the 31st of May, associated with an examination of the rating of the Portuguese Republic. Standard & Poor was considering that the main risks were weakening of political support for the program, unfavorable macroeconomic developments, missing fiscal targets, uncertainty regarding the stability of the financial sector, and insufficient pace of structural reforms. Now, the point of this slide is to persuade you, first of all, that the situation in May 2011 was very uncertain, and to persuade you that, according to all these elements, the situation is much less uncertain now. The program, as you may know, was requested in April 2011. It was decided in May 2011. It was formally signed in May 2011. Portugal had elections on the 5th of June. So we benefit from the fact that there was a very open debate about the characteristics of the program and what the program would entail before the elections. The 3 major Portuguese political parties subscribed to the program and ran a political campaign on that basis. They got 80% of the vote in the elections, and they got 90% of the members of parliament. There were 2 left-wing parties with parliamentary representation that campaigned against the program, and they got less than 20% of the vote, and they got less than 10% of members of parliament. Perhaps even more important than that, the social support for the program has been holding strong throughout the period, and in my reading of the information that we get from the polls, the social support for the program has been broadly constant over time. Standard & Poor was fearing unfavorable macroeconomic developments, and what we see in this period is that in 2011 the recession was milder than expected at the time of the program. A contraction of 2.2% was expected, and the outturn, according to the latest estimates, is 1.6. The current account was corrected much faster than in the program. As a matter of fact, the current account deficit at the end of 2011 is already below what the program foresaw for the end of 2012. The main driver behind this developments has been the dynamism of exports, which suggests that the Portuguese economy is able to adjust faster than experts thought at the time of the design of the program. The fiscal targets were not missed, but I will speak about that a little bit later. The adjustment of the financial system has been very successful. And finally, one of the emblematic areas of the program, an area that the government emphasized a lot, is the area of structural reforms, where the privatization process and the social agreement on a very broad and deep change in labor market, in the labor market framework, which was reached in an environment of social dialogue, are very important symbols. So along all these lines, we have quite substantial progress. I will jump the relatively favorable developments in treasury bill markets, because I'm sure that you will ask me about that. Now, when we come to the delivery of results, one aspect which I believe is very important has to do with, indeed, the compliance with the fiscal limits in the program. The program envisaged a ceiling, a limit of 5.9% of GDP for the budget deficit in 2011. The outturn was well below 5.9. It is something in the vicinity of 4%. But that was only possible because of the partial transfer of banks' pension funds to the general government. That one-off operation has an impact of about 3.5% of GDP. So you could say, perhaps, from a structural viewpoint, we have a substantial slippage to explain. But indeed, what you see if you use the IMF's Fiscal Monitor update, which was published in January this year, is that the structural adjustment in 2011 for Portugal was 4 percentage points of GDP, and that stands out, and that's what the slide shows you, when you compare with other euro area member states and the average of the euro area. The adjustment in Portugal was 3 times as large as the average of the euro area, which shows that we not only fulfill the limit in the program, but also were successful at a quite strong adjustment in the structural budget deficit, despite the fact that we had a change in government in mid-year that makes clearly the budgetary implementation more challenging. This slide basically shows that in terms of headline number, Portugal is below the average of the euro area, but that is less significant than the previous slide because indeed we have a very large one-off effect that other countries do not have. Now, this is one of my favorite slides, and I beg your pardon for that. This uses not the debt sustainability analysis of the third review, because that's not in the public domain, and because I want to compare Portugal with other countries. So this is the debt sustainability analysis that the IMF made public in December 7, 2011. Another one is about to be made public, which is actually more favorable than this one, but I want to use this one for comparison's sake. So what you have here is that the public debt to GDP ratio is supposed to peak at 118, according to this projection, in 2013, and then it will fall by about 2 percentage points year after year until 2016, which is the last year of the projections. Now, what you see here is if you compare the public debt to GDP ratio path for Portugal and for Greece, you see that the path for Portugal is uniformly below that of Greece. And as a matter of fact, it's below the level of 100% of GDP, which was fixed as an indication of sustainability for the Greek case by 2020. Now, also interestingly, the orange line is Italy, and again, Portugal is always below the line for Italy. But perhaps the most interesting aspect of this slide is that there is almost a coincidence between the debt path as a percentage of GDP for Portugal and Ireland, which in a sense illustrates the fact that both countries are found, according to this analysis, to have a sustainable debt position. We will jump over this slide just to show you that indeed, according to the latest numbers, the debt sustainability analysis of Portugal is more favorable than there. This is not only based, the results on the budgetary side are not only based on expenditure cuts made under immediate pressure. On the contrary, we have a very deep change in the rules and procedures that apply to the public sector. So we have a structural change process going on in the general government that will lead to sustainable, better results as time goes by. On the leveraging and financial stability, I will not use slides because I want to save time. On the leveraging and financial stability, what is going on is a process of adjustment which is operating faster than foreseen in the program. Portuguese banks are at this point in time much better capitalized than they were at the beginning of the program, and they have been able to deleverage in a relatively fast way by selling non-core assets and by attracting additional bank deposits. If you compare Portugal with other program countries, Greece and Ireland, one of the features that Portugal has, which is different from the other two countries, is that bank deposits have been increasing throughout the period. As a matter of fact, bank deposits in Portugal have increased more than in the average of the euro area. So the leveraging and financial stability are progressing in accordance with the program. These issues were discussed in detail during the third review of the adjustment program, so there's a lot more to be said, but in the benefit of time, I will move on. Structural transformation. I don't want to, again, spend much time discussing structural transformation because I really want to have a dialogue with you, but there are two issues that I have to cover. And the first one is that structural reform is really central to this program. As I indicated in the diagnosis part of my presentation, Portugal, during the easy years of the euro, indulged in a situation where it tolerated deviations from competition and allowed rents to accumulate in sheltered sectors, non-tradable sectors. So markups in product and labor markets are quite considerable in Portugal. Studies by the OECD and by the Eurosystem suggest that bringing those markups to average levels in reference economies would lead Portugal to have a benefit in terms of level of potential GDP of about 10% after 10 years. If you look at the chart on the slide, you see that Portugal stands very close to Italy. So on this particular metric, Portugal and Italy are very close together. The impacts on growth after 10 years are quite sizable. We can expect significant impacts over the medium term, and the medium term can be considered a period ranging from 3 to 5 years. And about half the effect can materialize over this medium term. Now, the debt sustainability analysis that I showed to you is performed assuming that there is no change whatsoever in the potential output growth path. Since the case for substantial impacts on growth from structural reform is actually, at least to my mind, very persuasive, that's a very important element of robustness in the program, because indeed, with this type of effects, adjustment will be faster, and the debt to GDP ratio, for example, will be coming down faster than in the program. Now, these aspects having to do with this reduction of markups in labor markets and product markets have to do with labor market reform that I already mentioned to you, but also with a systematic approach to the reduction of rents in the Portuguese economy, and progress has already been made in areas like pharmaceuticals, like telecommunications, and we are going to be making further efforts to reduce rents, for example, in the energy sector. The other aspect that I cannot fail to mention is the privatization program. We have already sold the participations of the government in EDP, that's an energy producing company, and REN, that's a company that does electricity and natural gas distribution, so it's a network. The revenues that we were able to gain through these operations are considerable by Portuguese standards, and they constitute already 60% of the total amount of revenue from privatization, which was foreseen for the whole period of the program. I should probably say to you that the main actor in the privatization program is Maria Luisa Albuquerque, who's sitting there, and the most knowledgeable man about the structural reform agenda is Carlos Moeda, who is also sitting there. So in case I need help for the question part, I have excellent support. And so, with your permission, I conclude. This is my last slide. How will this work? How can you be reasonably confident that this strategy will actually function as predicted? First element is that for Portugal and for the Portuguese, the adjustment is regarded as unavoidable. And so the consensus on the need for adjustment is a very important asset, and this consensus explains the broad popular and social support for adjustment, which has been constant over time. Secondly, as I already tried to argue, the program addresses the fundamental imbalances and deficiencies that led Portugal to the crisis. Therefore, the adjustment program is the adjustment program of Portugal. It's something that we regard as solving our main problems and challenges, and therefore we have a very strong sense of ownership of the program. The program allows us to eliminate the budget deficit on a lasting basis, and that change is supported by deep structural changes in the fiscal policy framework. Part of those changes explained by changes at European level, including the fiscal compact. We will have a situation in which the external deficit, the current account deficit, will be eliminated, and in 2 or 3 years' time, we expect the current account to be in a position of surplus. Finally, we want to implement the agenda of structural transformation as fast as we possibly can, because we believe that that boosts potential output and competitiveness, and therefore it's the basis for employment creation. And it turns out to be a fact that unemployment is the most acute problem that we're facing at the moment. The program is, this is the third element, is robust. And it is robust because the favorable impacts from structural reform on potential output and on the speed of adjustment are not taken into account, while the evidence that we have from adjustment in 2011 suggests that the Portuguese economy actually adjusts much faster than one envisaged originally in the program. Finally, and most important, the program allows for a gradual build-up of credibility. The program shelters government financing from the vagaries of financial markets. The program allows us to be out of bond markets until 2013. The program includes quantitative objectives and targets that are steered and monitored in the regular reviews of the program. And before the crucial date of September 2013, we'll have a total number of 9 reviews, and success on a quarterly basis 9 times in a row will be compatible with quite a substantial increase in credibility and confidence. And more generally, compliance with the program and success in adjustment will change gradually markets' expectations and perceptions, and therefore will allow us to manage our path back to the bond market at close to normal market financing conditions in time for September 2013. I'm at your disposal for questions and comments, whatever you may want to contribute. Thank you very much.